We're looking at some investment strategy now, and joining us for that is Maarten Ackerman, investment strategist at Citadel. Hi, Maarten.
Hi, David.
You know, on these shows, we look at these numbers all the time and this percentage shifts or fractions of a percentage and so on. Your job is to look at those, but you've actually got to look long term when it comes to strategy.
Yes.
It's what strategy is about. You've just done a presentation for Citadel called The Power of the Invisible Hand. What's that referring to?
Yes, I think, Adam Smith in the 1700s started this whole thing about the invisible hand, meaning that we should actually allow markets to correct for imbalances. And especially in Europe, what we've seen over the past 3 years is actually a very strong visible hand. Government is really interfering. And as part of that, we don't get to a solution. So it is this massive political game, probably more driven by Germany because they've got a big benefit having a weaker currency as a result of some of the peripheral countries in terms of helping them export more to the rest of the world, reducing unemployment, but we're not getting to a solution. So it is making a case to say that we need to allow the market to get to the final solution. And if we look at what's been happening in Europe, the politicians are losing the race. You know, we've seen massive changes in most governments. Merkel is the last one standing. They're coming up for elections and she's becoming less popular. So we definitely might see a change that's more in line with the economies, and the economy finding a solution rather than a political solution.
If you were to sum up the invisible hand, let the invisible hand work. Greece would exit the Eurozone, the drachma would come back, there would be a huge collapse in some things and then growth in others as tourism and a weak currency and so on. Is that what you're talking about?
I think the most likely event at this point in time is definitely Greece leaving within the next few months or next year or so.
Which is, in the end, is the market defying what governments are trying to do.
Exactly. So that's the only way that Greece will be able to get back to sustainable growth. If they go back to the drachma, you might see a 60-70% drop overnight. That's basically a default. But suddenly they will be more competitive. And for us, a Greek holiday will be 60% cheaper. So it's a matter of time when people actually go back to that country, they will create jobs. And some of the other peripheral countries will say, well, there's actually a benefit leaving the euro.
And there are those who say, let's just get it over with. Instead of trying to pull money down the drain.
Let's just get it over with. So Greece definitely, if you think about some of the other scenarios, I think maybe something interesting is to say that everybody thinks that Germany will keep it together. I think after the change in government in France, the new president Hollande, he's got more support from Spain and Italy. And we know that Spain is having severe problems at the moment. They're much more pro-growth and they also want to issue ECB bonds, basically saying that, listen, we will issue bonds to solve these problems. Merkel is on the page where she's saying more austerity and we're not going to issue bonds. Why? Because they know that if they issue ECB bonds later on, Germany will again be responsible for those.
And in the end, someone's got to guarantee bonds.
Someone should guarantee it.
And you've got to be credible. Let's look at the different big major investment areas, Europe, China, the USA. Just take us quickly through what you see in each of them. Europe first.
So I think the biggest risk for the global economy currently is Europe. I do think that it won't be a crisis anymore. We had more than enough time to prepare for that. A lot of the bad news is already priced in. If you look at bond markets or equity markets, if you think about what's happening over this weekend for Spain specifically, something is going to happen with Europe down the line. It's probably going to be a new or different structure Europe, but I think we had time to prepare for that. So while we're in this kind of mess, yes, there will be uncertainty and volatility as we muddle through that. If you then think about China, which is the second biggest economy.
You say on your presentation, China hard landing, question mark?
I don't think so. I think yesterday with the cut in interest rate is actually the right evidence that they had the intention to slow the economy, it worked, and now they're starting to make credit easier again. There's this fear about a property collapse in China, which we don't think is the same as the US. A lot of the Chinese are much more prudent, they've saved, and they are buying those properties cash. If you think about the role the consumer are playing in China, BMW over the past 2 months took, the biggest market is now China and not America anymore. So China is slowing down, and we think it's just soft slowing and not a hard landing.
I was saying earlier to Noreen, they can't win. You cut the rates in order to do what people think you should do.
Exactly.
But no, that's negative. But let's look at the USA.
The US, I think, is probably the third risk, if you like, in line. is very dependent on what will happen in Europe and China. On their own, they're doing fine. They're in a much better state than 2008. A lot of the companies deleveraged. The consumer are healthier. They're adding jobs. The funny thing is last Friday, 70,000 new jobs added. The market negatively reacted because they expected 100,000, but they're still adding jobs. So more people are working, more people are demanding, retail sales are up, real disposable income is up, and I think the fundamental thing that's changing is the property market. That's the root that caused this whole mess. It seems like we're in the bottom or turning around. New home sales up 3.5%, builder confidence up. So the US on their own is doing definitely better. And if we don't see a calamity in the rest of the world, they are likely to surprise on the upside.
Yeah, it's a bit like when a company reports profits, but they're not as high as people expected. They're still profits.
Exactly.
You're still getting something
You're
out.
still getting growth.
Yeah. Let's look where the value is going to come in your strategy, looking ahead there.
Yeah. I think at the moment, again, taking a longer term view and the message about the visible hand. The visible hand, unfortunately, at this point in time, is pushing down bond yields. For a specific reason. You know, if you think about bond yields in the West, they call it 1.5 on average. Inflation is still 2.5. So they're taking savings from future generations to pay back debt or to reduce the debt levels. So people think bond is a risk-free investment. In fact, I think it's a lot of risk going into bonds currently. Yes, if we see full-blown deflation, bond yields can go from 1.5 to 2.8, like we've seen in Japan. But you know, at these lowest levels ever, the likelihood for capital risk going forward is quite big over the next few years. So we're very, very cautious when it comes to bonds. If we do have bonds in the portfolio, it's typically lower duration, where it's less sensitive to interest rate changes. We still believe that the best opportunity for value investors right now is to make use of the uncertainty and buy some decent companies globally at a massive discount.
Well, let's look at that. Ask you to look at particular sectors and perhaps one or two, if you had to choose
Yes.
long term, what would that company or companies be?
Well, in terms, if you're purely on valuations, the fact that there's so much negative news in Europe, you can buy your best bargains in Europe at the moment. So if you can take the view and say that Europe will restructure, there will be a change, then buying some of those companies at P ratios below 10, below 2, over the next 5 to 10 years, you'll make proper money. Those companies are much more dynamic than the economy. So they've readjusted, they've paid back debt, they sit with massive cash on their balance sheet, and if you take an example like Nestle, they're paying dividends north of 5%. So that is much higher than what you'll get from the government.
These are good companies.
It's very good companies, and they're not only reliant on Europe, they operate in the rest of the world. So on a valuation basis, as a contrarian investor, we still feel that there's a lot of value in Europe and even the UK. The US is still offering good value. They're still trading way below their long-term averages, but there's a lot of positive news, what we've discussed already pricing. They had a very good 2011, they had a very good year to date. So some of that positive is already priced in. So from a valuation opportunity, definitely more value in Europe, UK, also in Asia, given the hard landing fears in China, and it's becoming less in the US, but it's still trading below the long-term average.
Well, it sounds more like common sense than contrarian. That was Maarten Ackerman, investment strategist from Citadel.